This week, the Fed made a big move again. They cut the benchmark Fed funds rate by 0.25%, bringing it to a new range between 3.75 and 4%. It sounds like good news for your mortgage, but hold on for a second, because what I'm about to tell you is going to surprise you. Hi, I'm Kevin Martini with the Martini Mortgage Group. This week has been action-packed. The Fed lowered rates again following the September cut. Now they're trying to balance stubborn inflation with a, let's say, cooling job market. Inflation is still sticky, folks. Job growth is slowing. And even though the government shutdown delayed some key reports, the Fed said the big picture has not changed very much. So they made another move. But here's the key. The Fed doesn't control mortgage rates. Let me repeat that. The Fed controls overnight lending rates between banks. Now, mortgage rates, they live in a completely different neighborhood called the bond market. Here's where it gets interesting. The bond market doesn't wait for news. It prices in expectation. Now, that translates to this. The mortgage market had already baked this rate cut into the cake weeks ago. That's why right after the announcement, mortgage rates didn't fall. In fact, they ticked up just a little bit. Because right after the Fed statement, Chairman Jerome Powell said, and I quote, "Another rate cut in December is not a foregone conclusion. Far from it." Wow. And just like that, the bond market said, "Cool your jets," and mortgage rates drifted higher. So if you're wondering why your rate quote looks a little different today, that's why. Now let's talk about what this means for you if you already own a home. Right now is your moment to connect with me or Logan Martini for a quick mortgage review. Here's why. We'll pinpoint your current cost of borrowing. We'll identify whether a rate reduction opportunity already exists on the table. And if not, we'll set a strike rate alert so you'll know exactly when to act. No guessing, no stress, just clarity. Because in a market this fluid, waiting without a plan is the real risk. If you're thinking about buying, let's revisit the old proverb. The best time to plant a tree was 20 years ago. The second best time is now. You know, if you had bought a home 10 years ago, your home value would have been up, get this, 94%. That's the power of time in the market, not time in the market. And speaking of timing, Fannie Mae recently shared a forecast. They expect mortgage rates to start with a 5 by 2027. When that happens, more buyers will jump in, and more demand means higher prices. That's why this saying still holds today. Marry the house, date the rate. Because you can always refinance when the time is right, but you can't rewind and buy at yesterday's prices. Case-Shiller and the FHFA both released new home prices data this week. The result? Home values are still higher than they were a year ago. Growth is slowing a little bit, yes, but it's still growing. If rates ease even a little, buyer demand can surge. And when that happens, home prices could climb again. So whether you're buying or refinancing, this is your moment to be strategic, not reactive. The Fed's walking a tightrope, balancing inflation, jobs, and growth. But for homeowners and home buyers, the message is simple. Control what you can. You can't control Jerome Powell, but you control your strategy. And that's where fiduciary-style mortgage planning comes in. At the Martini Mortgage Group, we help families align their mortgage with their bigger financial picture. So every move you make today supports your long-term wealth of tomorrow. If you're ready to move from curiosity to clarity, let's talk. Call me at 919-238-4934. I'm Kevin Martini, certified mortgage advisor with the Martini Mortgage Group. Until we talk, stay clear, stay confident, and remember, the right strategy always creates the right timing.